If you traded even $1 of crypto, bought a single NFT, or moved Bitcoin between wallets this year, the IRS has a brand new form with your name on it. And no, I'm not being dramatic. This isn't some rumor from Reddit. This isn't speculation. This is happening right now. It's called Form 1099-DA. The DA stands for Digital Assets. And starting in 2026, this form is going to change absolutely everything about how the government tracks, monitors, and taxes your crypto. Here's what keeps me up at night about this. Most people don't even know this form exists yet. They're going to file their taxes next year the same way they always have. Maybe report a few trades, maybe forget a few, maybe hope the IRS doesn't notice. And then they're going to get a letter, or worse, a penalty, or even worse than that, an audit. Because here's what the IRS isn't telling you loudly enough. They're building the infrastructure to see everything, every swap, every transfer, every DeFi transaction, every airdrop you forgot about 3 years ago. And if your numbers don't match their numbers, you've got a problem. So in this video, I'm going to break down exactly what Form 1099-DA is, who it affects, what the deadlines are, and most importantly, how to protect yourself before this becomes a nightmare. Stay with me. This one matters. All right, let's zoom out for a second, because to understand why 1099-DA matters, you need to understand what the IRS has been building toward for the last decade. See, the government has always had a problem with crypto. From their perspective, it's this Wild West where billions of dollars flow around, people make massive gains, and a lot of that never gets reported. And honestly, they're not entirely wrong. Studies have shown that crypto tax compliance is embarrassingly low. Some estimates suggest that only 20 to 30% of crypto holders actually report their transactions accurately. That's not because everyone is trying to cheat. It's because the system has been impossibly confusing. Think about it. You buy Bitcoin on Coinbase. You transfer it to a hardware wallet. You swap some for Ethereum on Uniswap. You stake it. You claim rewards. You bridge it to another chain. You buy an NFT. You sell that NFT. You get an airdrop you didn't ask for. How the hell are you supposed to report all of that? For years, the IRS basically said, figure it out yourself. They gave minimal guidance, inconsistent rulings, and expected people to somehow calculate cost basis across 17 different platforms. It was chaos, and the IRS knew it was chaos. So what did they do? They went to Congress. Back in 2021, buried inside the Infrastructure Investment and Jobs Act, the one about roads and bridges, was a section that most people completely missed. Section 80603. This section expanded the definition of broker to include crypto exchanges, and it mandated that these brokers must report your transactions directly to the IRS, just like your stockbroker does with Form 1099-B. But it took years to figure out the details. What counts as a broker? Do DeFi protocols count? What about self-custody? What about NFTs? Finally, in 2024, the IRS released the final regulations, and they created Form 1099-DA, the digital asset reporting form that's going to bring millions of crypto users into the IRS spotlight for the first time. Let me say that again. Millions of people who have never received a tax form for their crypto activity are about to start receiving them. And if what you report doesn't match what the IRS receives, that's called a discrepancy. And discrepancies trigger audits. Now, here's the timeline you need to know. 2025. Brokers begin collecting your information under the new rules. They're building their systems right now. January 2026. Brokers start issuing Form 1099-DA for the 2025 tax year. You'll receive these just like you receive 1099s for your bank interest or stock dividends. April 2026. You file your taxes. And for the first time ever, the IRS will be cross-referencing what you reported against what Coinbase, Kraken, Gemini, and every other exchange reported. This is the year everything changes. Okay, let's get into the specifics, because the devil really is in the details with 1099-DA. First question, who counts as a broker under these new rules? The obvious ones, centralized exchanges, Coinbase, Kraken, Binance, US, Gemini, Crypto.com, any platform where you created an account, verified your identity, and traded crypto. These are definitely brokers. They will definitely be sending 1099-DAs. But here's where it gets complicated. The IRS also wants to include what they call non-custodial or DeFi brokers. Think about front ends for decentralized exchanges. If a company operates a website that facilitates your swap on Uniswap or SushiSwap, the IRS is arguing that they should be considered brokers too. Now, this is highly controversial. A lot of DeFi platforms are pushing back. They're saying, we're not brokers, we're just software. We don't custody funds, we don't execute trades, the blockchain does. As of now, the IRS has delayed the DeFi broker rules. They were supposed to kick in alongside the centralized exchange rules, but there's been so much resistance that they've pushed it back. But don't get comfortable. This delay is temporary. The IRS hasn't given up, they've just postponed. Second question, what gets reported on Form 1099-DA? Here's what the form captures. Gross proceeds from sales. Anytime you sell crypto for cash or trade it for another asset, that's a reportable event. The form will show how much you received. Date of transaction. Exactly when the sale occurred. Asset type. Bitcoin, Ethereum, whatever you sold. Cost basis, eventually. This is the big one. For 2025, brokers might not have complete cost basis information, especially if you transferred crypto in from another exchange or a personal wallet. But starting 2026 and beyond, they're required to track and report it. Third question, what about transfers? This is where a lot of people are panicking, and honestly, for good reason. Right now, if you move Bitcoin from Coinbase to your Ledger hardware wallet, Coinbase knows that crypto left, but they don't know where it went. Did you sell it on another platform? Did you lose access? Did you just move it to self-custody? The IRS knows this is a gap, and they're working on closing it. In the proposed regulations, there's discussion of requiring brokers to track wallet-to-wallet transfers. There's even talk of requiring cost basis information to transfer alongside the crypto. So when you move your Bitcoin to another exchange, that exchange receives your cost basis automatically. This isn't fully implemented yet, but it's coming. Fourth question, what about NFTs? Yes, NFTs are covered. If you buy an NFT and sell it for a profit, that's a taxable event. If you sell at a loss, you might be able to claim a deduction. But here's the tricky part. A lot of NFT transactions happen on platforms that don't require KYC. OpenSea didn't always require identity verification. Blur doesn't. Magic Eden doesn't. So how will the IRS track these? Blockchain analytics. The IRS has contracts with companies like Chainalysis and CipherTrace. They can trace wallet addresses, identify patterns, and in some cases, link wallets back to real people. Just because you didn't give OpenSea your ID doesn't mean the IRS can't figure out who you are. I'm not telling you this to scare you. I'm telling you this because the era of crypto being invisible to the IRS is ending. Period. If you've been sloppy with your records, now is the time to fix it. If you've been ignoring past transactions, now is the time to go back and account for them. Because the IRS is gearing up, and they have a lot of catching up to do. Now let me pull back the curtain a little bit. Because what's happening with 1099-DA isn't just about tax compliance, it's about control. Look, I'm not anti-tax. I believe in paying what you legitimately owe, but I also believe in calling out overreach when I see it. And here's what concerns me about the way the IRS has approached this. They've been intentionally vague. For years, crypto holders begged for clear guidance. Just tell us the rules and we'll follow them. And what did the IRS give us? A single FAQ from 2014 that said crypto is property, and then basically silence for years. Meanwhile, they were quietly building the infrastructure to track everything. In 2019, the IRS sent out 10,000 letters to crypto holders warning them about potential underreporting. How did they get those names? Coinbase was forced to hand over customer data in a John Doe summons. In 2020, they added a question to the front page of Form 1040, right at the top, impossible to miss, asking if you transacted in digital currency. If you checked no and you actually did trade, that's potential perjury. In 2022, they announced they were hiring thousands of new agents, with a chunk of that focused on wealthy individuals and complex returns. Guess what falls under complex returns? Crypto. And now, with 1099-DA, they're ensuring they don't have to hunt for information anymore. It'll come to them automatically. Here's the part that really gets me. The IRS is applying regulations designed for traditional finance to a completely different technology. Crypto isn't stocks. The blockchain doesn't work like E-Trade. DeFi doesn't have a CEO you can subpoena. And yet, they're cramming crypto into this old framework, creating impossible compliance burdens, and then penalizing people when they can't keep up. You know what the penalty is for failing to report a transaction? It can be $250 per missed form. And if it's deemed intentional, up to $500 per form. You made 500 trades last year. That's potentially $250,000 in penalties for paperwork. I'm not saying don't pay your taxes. Please pay your taxes. But I am saying the system isn't built to help you. It's built to catch you. And the only way to protect yourself is to get ahead of it. That means keeping meticulous records. That means using crypto tax software. That means if your situation is complicated, talking to a tax professional who actually understands digital assets. Don't assume you'll fly under the radar. Those days are over. Okay, enough doom and gloom. Now let's talk about what you actually do to prepare. Step 1. Gather your records, all of them. Go back to every exchange you've used. Download your transaction history, even the ones you forgot about. That random account on Bittrex, download it. That KuCoin account from 2021, download it. If the exchange is defunct or you can't access it, try to find email records of deposits, withdrawals, and trades. Anything is better than nothing. Step 2, track your wallet activity. If you've used DeFi, if you've swapped on chain, if you've moved crypto between wallets, you need to reconstruct that history. Tools like Coinly, CoinTracker, TokenTax, and ZenLedger can connect to your wallets and pull transaction data automatically. They're not perfect, but they're a lot better than trying to do it manually. Step 3, calculate your cost basis. This is the most important number. Your cost basis is what you originally paid for an asset, plus any fees. When you sell, your taxable gain is the sale price minus your cost basis. If you don't know your cost basis, the IRS will assume it's zero. That means you'll owe taxes on the entire sale price, not just your profit. Don't let that happen. Reconstruct your cost basis as accurately as possible. Step 4, consider filing amended returns. If you've underreported in previous years, you have options. The IRS has a voluntary disclosure program. Filing an amended return before they come to you is always better than waiting to get caught. Talk to a tax professional about whether this makes sense for your situation. Step 5, separate your wallets. Going forward, consider keeping your taxable trading activity separate from your long-term holdings. This makes tracking easier and reduces the chances of accidentally triggering a taxable event. Some people use one wallet for trading, one for staking, one for cold storage. Whatever system works for you, the key is organization. Step 6, stay informed. The rules are still evolving. The IRS is still finalizing guidance on DeFi, on NFTs, on staking rewards. What's true today might change tomorrow. Follow reliable sources. Subscribe to channels like this one that break down the updates as they happen. Don't rely on Reddit threads or tweets from anonymous accounts. Look, I know this is overwhelming. I know a lot of you got into crypto because you wanted freedom from traditional finance, and now it feels like the system is closing in. But here's the truth. Those who prepare will be fine. Those who adapt will thrive. Those who ignore this will get burned. Don't be in that last group. All right, that was a lot. If you made it this far, you're already ahead of 90% of crypto holders who have no idea what's coming. So here's what I want you to do. First, drop a comment below. Tell me your situation. Are you a long-term holder who hasn't sold? Are you a DeFi degen with 1,000 transactions? Are you worried about past years you didn't report? I read every comment, and I'll do my best to point you in the right direction. Second, if this video helped you, hit that subscribe button. I'm going to be covering every update on 1099 DA as it rolls out. The deadlines, the IRS announcements, the strategies to stay compliant without overpaying. Third, share this video with someone who needs to see it. I guarantee you know at least one person who traded crypto and has no idea about these new rules. Send this to them. It might save them thousands of dollars in penalties. And finally, if you're part of this community, drop 1099 ready in the comments. Let me know you're taking this seriously. Let me know you're preparing, because that's what we do here. We don't panic, we don't hide, we get informed, we get organized, and we protect ourselves. The IRS might be watching, but we're watching too. I'll see you in the next one.